What's going on, people? It's your boy Kalichi and welcome back to the channel. I hope each and every single one of y'all are doing well. In today's video, I'm going to be talking about how to build out your portfolio if you're just starting out investing. If you're a beginner investor, what is it that you have to look for when you're trying to learn how to invest? I was searching this topic on Investopedia, which is my favorite place to go to look up information on investing. And I really like the information to provide. So check out that site. They put a lot of good information there. But I wanted to talk about one of the things that I think is the most important thing to do if you're a beginner investor. Now, before we get into that, just want to update y'all on the portfolio. Not really much has changed, as you guys know. And my Robinhood portfolio is literally all ETFs. And that is where I want to talk about today. I want to talk about ETFs. Now, your question may be, what are ETFs? Investopedia defines ETFs as an exchange-traded fund is a type of security that is involved a collection of securities such as stocks that often tracks an underlying index, although they can invest in a number of industry sectors or use various strategies. ETFs are in many ways similar to mutual funds. However, they are listed on exchanges and ETF shares trade throughout the day just like ordinary stock. Now, the biggest news about this, or the biggest point about this that everyone should take out is this line right here where it says an ETF is a collection of securities. That's it. That's what you need to know about an ETF. An ETF is a collection of stocks. It's a bunch of stocks in one thing. And the idea of an ETF is it's going to track something in the market. For example, it gives one over here called the SPY or SPDR S&P 500 ETF, which tracks the S&P 500 index. Now, your question may be, what is an index? Basically, an index is a collection of things that you can monitor to see how the general market of that thing is doing. So, for example, for the stock market, the S&P 500 is a collection of about 500 of the best performing, well, not always the best performing, but some of the best companies in the world. And you use that to determine how the market overall is doing, how generally companies are doing and performing, and how the stock market is doing in general. And so an ETF basically just tracks how that's doing. Now, why this is a good way to do your investments is it reduces your risk. It takes away the risk assessment of you having to deal with having to know exactly what you have, having to know exactly what you own in it. For me, the ETF that I have selected is this ETF called the Schwab US Dividend Equity ETF. Now, this ETF is built to track the Dow Jones Index. Now, the Dow Jones Index is another big one that you're going to hear about a lot on the news when they're talking about the stock market. They're going to say, oh, the stock market has fallen. The Dow Jones dropped 1,000 points today. What they're referencing is a collection of, it's 120 or so companies, I believe. And basically, it's an old index that has been a staple index in the United States of places that you can basically, of companies put together. Now, when you're talking about investing in the stock market and when we're talking about this ETF thing, one of the things that a lot of people don't pay attention to and you should watch out for when you go searching any information about ETFs, one of the sites that I use to do a lot of research is called Seeking Alpha. And one of the things that you have to pay attention to when it comes to ETF is this number right here. This little number right here. It's the expense ratio. You don't want any expense ratio above 0.1% when it comes to ETFs. If we go to the pairs of this ETF, you will see different ones from Vanguard to Charles Schwab to Fidelity. You don't want an ETF that has way too much of an expense ratio because then it eats into your profits. It eats into the amount that you can make back. So for example, the Dow Jones Index has a return of about 7% year over year. Every year is going to return about 7%. Now, if you have an ETF that's eating up about 1% of your return, that means you're only going to get 6% back. Now, the problem is you may be saying, oh, that's just 1% out of the whole thing. But however, the problem is you also have to think about inflation, which is going to take 2% of your money. So now you're stuck at 4%. And then you also have to pay taxes on your growth, which is another which is another 2% from it. So now you're ending up with 2%. So when you have something that's taken away 1 whole percent from your returns, that's a lot. That's a lot that's being taken away from you. So you don't want to deal with that. You want this expense ratio to be very low. And that's it. You buy this, and the other thing that's important is you just buy it over and over and over and over again. You just keep buying it repetitively, and that's all you need to do. That's the only thing you need to do. You don't have to do all the fancy stuff that I do. I mean, I have an entire Excel spreadsheet just to focus on, am I doing well? Am I picking the right stocks? Am I calculating my book value? And all this other fancy stuff, doing all this tracking numbers, putting up graphs and all this stuff on your thing. You don't have to do all of that, because all you need to do is just buy an ETF and you will be good. That's it. Just buy an ETF and all your problems are solved. But anyway, that's all I have for y'all today. I hope y'all learned 1, maybe 2 things out of this entire podcast. I said podcast, my bad. This is not a podcast, but I do a podcast every Tuesday and Thursday. It's called the Rambling Mind Podcast. Check it out on all platforms. We talk about personal finance. We talk about investing. We talk about the business news of what's going on in the world so that you know how it's affecting your dollars. But anyway, it's been your boy Kalichi. Remember, generosity is always greater than greed. God bless each and every single one of y'all, and I'm out. Peace.